a couple of tips on how to position yourself to build your wealth during this next economic downturn. Last week, the Federal Reserve lowered the Fed funds rate. The Fed funds rate is really important because that's really going to determine a lot of the rates that consumers are actually paying on different consumer loan products. So this could be business lines of credit. This could be auto loans. This could be credit cards. When the Fed is lowering the Fed funds rate, basically what they're trying to do is stimulate the economy. Now, despite what a lot of these headline statistics and numbers say when it comes to the unemployment rate, when it comes to the S&P 500, when looking at those metrics, they say the economy is doing well. The stock market hit an all-time high. What's really going on is that we are in an economic depressive economy right now. A lot of people refer to it as a silent depression, even though based historically on what the numbers suggest, it's technically not a recession, right? When we're talking about a technical recession. But the real way to look at the overall well-being of the economy is not to look at the stock market or to look at the unemployment rate or a lot of these official government statistics. They'll wind up being revised later on. The jobs numbers was actually revised down 800,000 plus jobs. Look at how the average person is faring, right? Look at your neighbors. Look at your people you might encounter, right? How are they doing in this current economy? And that'll tell you everything you need to know about the true state of the economy. So that's why the Fed lowered interest rates. Now, if you watched that meeting last week with Jerome Powell, who's the head of the Federal Reserve, basically he was very crafty in how he actually described the current state of the economy, right? The economy is still strong. The economy is still doing well. And the reason why he has to say that is because the whole point of the Federal Reserve is to instill confidence in the economy, right? So they're not supposed to say that the economy is doing bad. It's the equivalent of, let's say your significant other was overweight and they ask you, how do they look? And you tell them they look great, even though deep down that they may not look great or maybe they're overweight, but you don't want to say that. That's a similar sort of relationship when it comes to the Federal Reserve, right? Because they don't want to panic the market. They don't want to actually admit that there's a recession, right? And so when you look at really what's going on, you have record consumer debt, you have the national debt over the $35 trillion. You have auto loan repos and delinquencies greater than the last Great Recession back in 2008. So we've exceeded the amount of delinquent and repossessed autos. And then you also have companies like Ally Financial, right? Their stock price just recently took a major dip because it was revealed that a lot of consumers are struggling with repaying those auto loans. And for anyone who knows Ally Financial, guess what? That's the no PG business vehicle play, right? Where people are able to build up and inflate their business credit worthiness and then go out and get these no PG loans where they're not really looking at the cash flow and they're not really looking so much at the personal credit of the beneficial owners of these businesses. Over the past couple of years, a lot of people were getting these vehicles financed through Ally Financial under their business. The underwriting of that was just flawed, right? Because you're giving people these vehicles, financing these vehicles when they really couldn't afford it. So you're seeing a lot of delinquencies there. I did a video a couple weeks ago on how Navy Federal has been charging off on average $300 million in bad loans in 2024. So as of September, they're probably close to about $2.5 billion in charge-offs. That's just at Navy Federal. And there was a recent report that was published by Credit Union Times, which is a news publication that gives a lot of information on credit unions. And they were basically saying that the amount of loan originations has decreased. And this is something that I've actually seen over the past year as well, because I work with a lot of these banks, credit unions, fintechs. So I see a lot of the loan conversion data, and I can definitely say that 2024 compared to, let's say, 23 and 22, the amount of loan approvals on the personal side as well as on the business side have gone down. And there's a couple reasons behind that. Most borrowers are not as qualified as they once were. You also got to take into account that a lot of the stimulus money, which propped up a lot of consumers and businesses, is for the most part dried up. And when I mean dried up is that most businesses and consumers have either already spent that money or no longer have access to that extra liquidity. So from a credit worthiness standpoint, they're not going to be as qualified. I mean, there's even tons of videos online where people are complaining about the increased cost of living, the housing affordability issue, high prices at the grocery store, right? So overall, I could say, even though we're technically not in a recession based off of the definition of a recession, which is, multiple consecutive quarters of negative GDP growth, when you ask the average consumer, it feels like they're in a economic depressive state. So how do you position yourself going forward to be able to take advantage? Now, since the Federal Reserve just recently reduced the Fed funds rate, what happens is the bank lending rate, which works in lockstep with the Fed funds rate. So the Fed funds rate was at 5.5%. Now it's at 5%. Now, the prime lending rate, or the Wall Street prime lending rate, that's what a lot of banks actually will price their products at. So if you have, let's say, a business line of credit, usually it's the prime rate plus a margin. So I'll give you an example. I have an M&T Bank business line of credit, which I believe my line of credit is prime plus 2, right? So at the time it was 8.5% plus 2. So the line of credit was 10.5% interest only. Since the Federal Reserve reduced the Fed funds rate and the prime lending rate works in lockstep, if you have any variable rate products like credit cards or lines of credit that are tied to a bank prime rate, then that's actually going to get lower because, again, the bank lending rate is the prime rate plus 3, right? So if you had a business line of credit at 10.5%, you'll probably soon get a notice that it's dropped down to 10%, right? Based off that meeting with the Fed and Jerome Powell, they basically hinted to the fact that there will be additional rate cuts throughout the remainder of 2024, as well as in 2025. So they have their target Fed funds rate for the end of 2025, which would be significantly lower than what it currently is. So the way you position yourself going forward, knowing this is actually going to happen, is that you're going to have a lower borrowing costs, right? So for business lines of credit, for credit cards, things like that. So the way that you take advantage of this is just being in position to be able to participate in the capital markets, right? So being able to secure money from the banks, because going forward, you're going to have a lower cost of capital, which is going to put you in a much more competitive advantage versus people who cannot access these capital markets. So how do you access money from the banks? Number one, you want to get your credit in order, right? Going forward, what's going to happen is that the banks have tightened up their underwriting. So they're still going to lend out money, but they're going to lend money to more qualified people. If you're someone who has your credit in order, has your paperwork in order, has verifiable income, you're going to be able to get access to the money. And then what's also going to happen, since the Federal Reserve lowered the rates, what they want to do is potentially avoid a recession. So I believe that a lot of these, economic conditions are going to get worse. I don't think we're done with defaults. I think defaults are going to continue to increase. And again, I have a lot of anecdotal evidence and observations from this, just being in the credit space, talking to business owners, consumers on a daily basis. So many people right now are burdened with high utilization, right? Because of inflation and because people's incomes have not kept pace with inflation, you have a lot more people, not just low income, but middle class and even upper income people who might have higher cost of living are carrying more debt month to month, right? And not paying it off in full. So what's happening is that people's credit scores are going down because they're carrying more debt. More people are transitioning into defaults. And so I think it's going to take a couple cycles before we actually start to see some of the positive economic benefits from lower rates. That's not going to happen immediately after the Federal Reserve lowers the interest rate. It's going to take several months for it to circulate through the economy. Banks open up lending, or not necessarily open up lending, but lower borrowing costs for businesses and consumers, meaning that they're going to have more income versus the current interest rate. So if you're paying 8% versus 7.5%, you're going to retain more of your money. So with these lower borrowing costs, that'll actually help consumers and businesses and even incentivize people to borrow money and circulate that money throughout the economy. So the way that you position yourself right now to take advantage, because what's going to happen is we're going to see a lot of businesses for sale, right? Because right now, a lot of small businesses are suffering right now. We're going to see more repossessions. So if you're looking for used vehicles, if you're looking for any assets on sale, that even includes current homes for sale, right? There's a lot of economic pressure. We haven't seen most of it play out yet. So if you are positioned and you have your credit and your paperwork in order, then you're going to be able to take advantage because you're going to be able to have access to the capital. And I tell this to people all the time. Having access to capital is the difference between you being able to secure assets, right? You being able to execute versus when you don't have your credit right, when you don't have your paperwork, when you don't have verifiable income, when you're not filing your taxes, you're not going to get these 120,000, 250,000, whatever amount of capital it is to go out and purchase assets, right? So assets are about to go at a discount. This is something I've seen across the board, even working with small businesses who are looking to acquire businesses. Right now, there's a lot of businesses that are trying to exit, right? They're trying to get out because business has been slow. A lot of people I talk to right now, if you do have the capital, you're going to have a much better negotiation when it comes to purchasing some of these assets. So what you want to do, you want to get your credit in order. If you have derogatories, you got to get that cleaned off, especially if you're a business owner. Now, I know sometimes people come to this decision, well, I have some negative items. Do I just wait 7 years for it to fall off? If you're just a regular consumer, you don't plan on leveling up, then yeah, maybe wait 7 years for it to drop off instead of paying for credit repair. But if you're a business owner looking to make moves, I would definitely suggest that you get that process initiated. Again, you don't have to go through us, but just get your credit fixed however you can. If you do need assistance with that, we can actually help you get accounts removed off your credit report. There's a link down in the description of the video. Aside from that, what you want to do is have verifiable income. So I was on a webinar last week. This was through the American Banker, which I have like a premium subscription, and they have a lot of these webinars. So they hosted one with Plaid, and there's a company called Prism Data. So both of these companies are at the forefront of cash flow underwriting. What they were saying was that in the next 3 to 4 years, they predict that about 80% of banks and financial institutions will be incorporating some type of cash flow based underwriting. And the reason why is because credit score based underwriting alone is not a good enough way to get a full picture of the credit risk of prospective borrowers. So they want more data points, more insight, more information. Remember, credit scores are backwards looking, whereas cash flow based underwriting, they're going to have a much more up to date view of your financial picture. And then at the end of the day, do you generate enough income to service the debt? With credit, you're always kind of lagging behind. So they're basically going to be incorporating that data with a lot of institutions. So what you can expect in the same way that I talked about this 4 or 5 years ago with Plaid, banks are going to want to see some type of verifiable income. If that's not through your banking activity or through your accounting software or through your payroll, right? So you're going to want verifiable income going forward. So if anyone needs help with that, whether that's an accounting system, whether you need to pay yourself through a business LLC to show that you have verifiable income, we have links in the description of the video. So again, just to recap, to position yourself to build your wealth during this next economic downturn, you want to have your credit in order and you want to have verifiable proof of income. That's all for today. Until next time, take it easy. We'll talk to you soon.